The system we live in is quite interesting, as in it favors a few people that understand some details about it at the expense of the vast majority of people. We all know how there is an expanding money supply, right? USM2 is going up quite consistently. Over the decades, it's growing by roughly 6.8% per annum. Now, at the same rate, we also see, or maybe slightly above that rate, we see how the S&P 500, so US stocks, are growing. So the majority of the price increases in the stock market are due to just monetary expansion, due to money printing. Now, most people just want to basically escape that monetary devaluation. So let's say you're saving a lot, right? You're working all those years, you're saving 10-20% of your income. Over the years, you get quite a bit of capital, and you don't want that capital to just melt away. So because of this expanding money supply, because of the devaluation, or just because of how people say inflation, right, the official 3% per annum, because of that, you simply are forced to invest. You go maybe to a bank, you maybe go to your friend, you ask, what should I buy? I'm not really interested in the topic at all. I just need to be safe that whatever I'm putting in will hopefully be worth more, but will at least be worth the same kind of purchasing power in a few years from now, maybe later on when I retire, or when I want to give some of that money, say, to my children. So that's usually what's going on for most people. Now, the problem is when we allocate, say, to the S&P 500, yes, over the decades, say over 30, 40 years, we tend to get our purchasing power back. But the problem is we get this at the expense of a lot of volatility, as in, if you buy the S&P 500 now, even 10 years from now, you might have less purchasing power. You might have more US dollars, as in the US dollar amount went up, but you might be able to buy less with it because the monetary debasement was faster than whatever kind of return you got over those years. So you're protecting your purchasing power only over the long term at the expense of potentially destroying the purchasing power in the short term. So that's a fundamental problem. Another problem is that once you get into this whole idea of investing and you learn more and more about this, that in the end it seems like relatively easy to beat the market, right? It seems relatively obvious. We've got our trends. Sometimes things seem cheap, sometimes things are expensive. So if we just try to buy when it's low and we sell when it's high, then maybe we can actually make some additional money. So people get lured into speculation, into short-term speculation. And a lot of people burn themselves. Maybe they buy some trendy stock that then afterwards comes crashing down. They listen to, say, the financial news. They hear about something that might be interesting. They hear an interesting story. They buy the thing, they get burned, and they lose a lot of their money. And that's then when they learn, okay, maybe I should just buy the ETFs and that's it. That's all I can do. But I don't think that's actually the right learning, because again, we expose ourselves to the long-term volatility. And if you buy, say, the S&P 500 now, it could be very problematic because a lot of the value that's currently in the S&P 500 is just AI stocks. And actually I also want to talk about how this actually happens. So let's say you deploy your capital now into the VOO, or even buy, say, a global index, right? So the MSCI World. You buy something like this, a lot of your capital will get allocated towards the US, and within the US, it will get allocated towards technology stocks. So let's say you buy something like the MSCI World, 60 to 70% of that capital will be just the USA. And even within the US stocks, the vast majority of it will be just the top 10 stocks. And a lot of that is just Google, Facebook, Netflix, all these stocks, right? Nvidia, very tech-heavy stocks. And we know that there's a lot of speculation around artificial intelligence now, right? A lot of investment in the space. So you think you're diversified, you think you buy the entire world, but in the end you end up buying just tech stocks mainly, and you get still a lot of exposure to that narrative. And if there is over speculation, if there's something like the .com bubble burst, which we don't know, right? At some point valuations might come back down, then of course you will be exposed even with a diversified portfolio as well. What I find interesting, and this is something not many people talk about, is dollars invested does not equal market cap. So when you move $1 into an asset, the market cap tends to increase by much more than $1, depending on the liquidity. So let me show you what I mean. Let's say you've got a street with equal houses. Let's say a long street, a narrow street. Every house looks exactly the same, is exactly the same, has the same specifications. They're all worth the same. So let's say we've got 100 houses, and each of those houses is worth $1 million. Okay? So we've got the market cap, or the market value of our houses on the street is in total 100 million. So that's a market cap. Now, let's say nobody wants to sell the house, everybody is super happy, and then somebody from outside comes in and he really wants to live on that street as well. And he asks around, he wants to buy a house, nobody wants to sell it. Then finally one person says, okay, I'm willing to sell it for $2 million. So then the transaction happens, $2 million, that's then the amount of money that moved hands. Okay? So one house sold for $2 million. Now, the way this works is, because all those houses are pretty much the same, we can compare them, and so we should now value them all the same way. All the houses are now worth $2 million. This is valuation by comparables. And this is also very common in the stock market, right? We look at comparable companies, what's their market value. If you want to, for example, value a private company, that's how we do it, right? You would look at what's the multiple of revenue, what's the multiple of earnings, how should we then thus value this private company. So because the $2 million moved hands on that street, suddenly the market cap of the entire street moved from 100 million to 200 million. So we've got a multiplying effect of 100x, right? Just because of the single transaction, because of the little liquidity, right? If there's very little liquidity, one single transaction can move market caps massively. So what does this then mean for the concentration, the capital concentration? When you buy the S&P 500, for example, right? You buy stocks of all the companies in the US that are listed, basically, or the top 500. When you do that and you're allocating a big portion of that towards Nvidia, towards Facebook, towards Google, when you're doing that, you're investing in those companies, and so by putting $1 in those companies, the market cap of those companies increases by more than $1, thus concentrating capital even more. So the next person that's going to buy the S&P 500 is again even more purchasing those highly valued companies. So because $1 in the market increases the market cap by those already expensive companies by even more than $1, they will get more and more ownership. They will get more and more dominance within the market. So because there is more and more passive investing going on, because less and less people believe that they can beat the market, because many studies also showed that, right? The vast majority of traders are not able to beat the benchmark. Because that's now the common narrative, more and more people do passive investing, and passive investing, because of that leverage effect, will lead to more and more capital concentration towards the few winners. And that's one of the reasons why the tech companies have this vast share of the overall market capitalization. That's why the top 10 companies now own more and more of the S&P 500. And the more we will see passive investing, the more we will see that concentration going on. And that's why there might be also the malinvestment into the AI space. It's not that everybody believes in AI, it's simply just because of the mechanics, how passive investing works, that all those companies get all this capital and they don't know what to do with it. And instead of just buying back their own share, or instead of paying out dividends, what they do is they try to make this capital somewhat productive. And by being productive, they just say, okay, let's buy into the next wave. And Facebook tried this with virtual reality. That didn't really work out that much. And now all the companies are trying this with artificial intelligence. So that's currently what's going on. Isn't that interesting, right? Most people don't really think about this leverage effect of market cap, how this fuels concentration, and how this is all just based because of passive investing. Now, what do I personally do because of that? What I think is actually going on here is that most people are mistaken. As in, Yes, it is true that it's very hard to beat the market. The vast majority of people don't beat the market. They don't beat the benchmark. When you pick a random stock, say out of the S&P 500, and you try to beat the S&P 500 with that random stock, the likelihood of you failing is extremely high. It's like 70-80%. So again, it's a winner takes most market. Returns are very much concentrated towards a few winners, and the vast majority of players do not beat the benchmark. Or in other words, the average return is much higher than the median return. Right? The median company performs much worse than the average company because returns are very much concentrated. There are a few winners that get most gains. So if you pick something at random, you have a very high chance of actually not getting the average return. You have a much higher chance of getting the median return, which is lower than the average return. Now we already know that the average return is just close to the monetary expansion, right? The money supply grows by 6.8% per annum. And so if you buy the S&P 500, you get that. You get maybe slightly more, but you also have to pay taxes. You also have to pay management fees. So after taxes, after management fees, do you really beat monetary debasement? Maybe not. And that means you get the average return. Right? So if you invest in the median company, if you pick your assets, and you even potentially get more taxes because you trade more frequently picking individual stocks, that's probably a losing game. But think about it the other way around, right? When you just take the benchmark now, if you accept the average return, you are also allocating capital towards a sector of the economy and towards certain companies that already have too much capital, that already have over allocation because of that leverage effect, right? $1 invested increases market cap by more than $1, and so the dominance within the market increases, and those companies get more and more until they overinvest into one sector too much, and then they collapse. So if you don't want to be part of that, right? If you don't want to be exposed to that, you have to ask yourself, if you currently see the market being overvalued, which I personally do think it is, right? When you look at historical price to earnings ratios, when you look at historical price to sales ratios, book to price to book value, etc. When you look at all of those ratios, when you look at the S&P 500 market cap relative to the monetary supply, when you look at all of these things, it seems quite clear that we are overvalued. So if that's the base case, then what can we do to beat the market without trying to find a few winners, right? Without having the odds against us, without having to bet on the 20% probability of outperforming, right? Because 80% tend to underperform. So what we can do is we can bet on falling prices, right? We can short the market. This is a bit more advanced, but in order to get outsized returns, we of course have to use approaches that most people don't do, that don't follow. The problem, of course, with betting on falling prices is that then we've got the issue that the monetary base expands. As in, if we bet on something going down, but the money devalues by 7% per annum, we still need to find something that goes down by at least 7% per annum, right? Because everything per default should be trending up if the US dollar goes down over time. So that's why a short is called a short. Right? There's short positions, there's long positions. Long positions are positions that are supposed to be held for the for a long duration, right? For the long term. Those are positions that bet on rising prices. Short positions are called short positions because they're intended to only be held for a short period of time, and they are the ones that are betting on falling prices. And this all makes sense given that the money devalues over time. But what I think is a good approach is to use relative valuation bets. So I'm doing this already in the crypto market quite extensively, but I do think this can be applied to the stock market as well. So what we want to bet on is that one company does worse than the benchmark, does worse than the average return. So what we would be doing is we bet on a rising, say, S&P 500. So we are buying a VOO, but at the same time, we are betting on a falling individual stock because 80% of stocks tend to do worse than the average return, right? Over the course of 1 year, roughly. So if you then compound this, of course, the ratio gets even more skewed towards the average return outperforming the individual stock. So what we do is we don't try to pick the winner. We don't try to play against the odds. We try to play with the odds. So we try to find a loser. Now we don't want to find something that's still hyped, where people or hyped in the way that it has a lot of attention, right? We don't want to bet on a stock where everybody talks about the stock will go bankrupt. We want to bet on the boring stocks. We want to bet on the stocks that are already very large, that have a lot of corporate bloat on top of it. If you've ever worked in a big corporate company, you probably know what I'm talking about, right? There are many people that get employed to do things that don't do any real value add, that don't provide any additional value for the customer. They simply just survived because maybe in the early days they got some kind of monopoly, and that monopoly has never been challenged, and they got a bit of pricing power out of that monopoly. But really now, because they add more and more bloat on top of that, they're not really that competitive, especially against the very quick growing companies that get all the hype, right? The AI companies. So if you've got a company like this, right, a big corporate giant that gets more and more bloat, that tended to already underperform in the last few years, potentially even decades, that's likely going to continue to underperform, that nobody talks really about, those are the ones that likely will continue to underperform. They are very unlikely to see any kind of turnaround, especially now that interest rates are relatively high and that PE funds or have a hard time just buying them up and restructuring them, right? This is sometimes the risk of betting on falling prices. If valuations of those companies are too low, then there might be private investors that buy up the company, split it up, make it efficient again, and they kill all the bloat. But when financing costs are very high, when interest rates are very high, it's very expensive to make those leverage those LBOs, those leverage buyouts. So because of that, it's still safe in a high interest rate environment to just bet on those giants, quote unquote, to underperform the average market return. So we can do a relative valuation bet. So we do a bet completely independent of what the macro environment is doing. So if the macro is continuing to go up, if the AI bubble continues to expand, it doesn't really matter to us too much, because we only bet on one asset doing worse than the average. So this is what I believe is the best approach in this market. It's not very conventional, it's not what most people do, but I think it's actually smart to have a long-term position open in a short. So it's called a short position, but we're actually having this open for a long time because we're hedging the short. We don't worry about the monetary debasement because at the same time we go long for the same amount in the average return. So we are delta neutral. So we could go short any kind of asset that we believe won't outperform, and we go long the average market. And that's how we can make money. So this is what I believe is the key to all of this. It's not easy to beat the market, but it's definitely possible. Now, of course, we don't want to have our entire portfolio in this strategy. We still want to be diversified, but we want to be diversified in a smart manner, right? We want to have this delta neutral approach. So delta neutral just means that we are agnostic to the price movements of the general market, right? If the market overall goes up or overall goes down, doesn't matter to us, because parts of our portfolio are long and short. We are cancelling out the overall macro environment. So we have parts of our portfolio in this delta neutral approach. We might have parts of our portfolio, say, in long-term government bonds. So we make money when interest rates go down, when the market freaks out, when people look for risk-off investments again. We might also have a bit of money, say, in physical gold, right? We might have a bit in crypto, potentially, when it crashes more. So we want to be diversified overall, but we don't want to go against our general thesis. If we do believe that the market is now overvalued, that doesn't mean that we have to still buy the S&P 500, especially when it's so concentrated towards tech stocks. We can be somewhat creative. The only important thing is that we don't become creative in a way that we speculate trying to pick the few winners, because that's how most people get burned. Right? Most people think I have to outsmart the market in a way that I find the few winners that make the 10 or 20x returns. That's not required, right? All what we are looking for is We want to outperform those 6.8% per annum. And that is definitely possible, right? It's definitely possible. We just have to find approaches that are not that common, right? We have to find the assets that or the approaches that most people don't yet follow. And that's currently my approach. So, for example, you might disagree with that, but for example, what I'm personally doing in traditional finance now is I have an open relative valuation bet on Tesla. So I am bearish on Tesla. I do not think that Tesla currently has a fair valuation. They've got a lot of investments in robotics. They've got a lot of investments in self-driving. And while I do believe those two technologies will at some point bring positive returns, I've got my doubts that they will bring those positive returns in the next 2 or 3 years. It probably will take some time until we see the monetization. The same way how we saw Tesla take a long time to get the Model S getting properly scaled up, and the way how it took a long time for Tesla to get the Model 3 scaled up. And until we saw that scaling, actually, Tesla did fell relative to the NASDAQ 100 by quite a bit. So I encourage you to look at relative valuation charts, right? Go to tradingview.com and look at your stock, look at your cryptocurrency, and then enter the ticker symbol, and then enter /, and then the benchmark. So say Bitcoin, or say S&P 500, or say the NASDAQ 100, or say the equivalent ETF VOO for the S&P 500, or QQQ for the NASDAQ 100. So just look at those charts. So for Tesla relative to the NASDAQ 100, that would be TSLA /QQQ, and then press enter in tradingview.com. You see the relative valuation chart. You then see how Tesla tends to be quite expensive and how it did have that kind of volatility of dropping 40, 50, 60% versus the S&P 500 at the current price levels. And I think those are the better bets. Yes, I do have my idiosyncratic movements here. I don't just get the general market return, but I don't think the general market return is good enough over the next 10 years. And it is okay to have individual positions in the market. The only important thing is that we go into this with the right expectations, right? The main reason why most people advise you not to take individual positions, to just do passive investing, is because most people just look at those stats, right? If you do individual stock picking, you've got an 80% chance of losing. But that's because of those concentrated returns. It doesn't mean that you can't have your own opinion and still bet on whatever you think is currently right. It is okay when you think that stocks are too expensive to instead buy property. It is okay to, when you think that property has crashed, to then take out the mortgage and to then buy aggressively. It is okay to bet on falling prices of individual stocks where you think they are overvalued. So it is okay to do this. Just make sure that whatever individual position you open is not against the general market structure. Don't bet half of your portfolio on a bet that tends to have a rate of winning of only 20%, right? Don't put all your eggs into one little investment that has asymmetric returns, right? If you do the asymmetric return thing, if you do swing for the fences, if you do try to make your 10x return, then have the position size accordingly, right? Then only bet 5% of your money on it, right? Then don't over allocate towards it. Because if you think that thing can 10x, then 5% allocation is more than enough, right? Then you already made 50% return, which is enough of monetary debasement for the next 7 years, roughly. So that's how to think about this, right? We want to beat monetary debasement. And if we want to beat the market, we can have our own positions, but make sure that you don't bet against market structure. It's still a winner takes most market. And if currently there's over allocation towards those winners, and you do think that those winners are currently practicing malinvestment, there's no need to go through the trough with those companies. It's better just to act according to your conviction. To not have too much stock exposure, but maybe to buy the next house, right, with low financing costs. And if that's not your thing, then, and you want to go down the rabbit hole of betting on falling prices, then feel free to do that. But again, don't open up short positions without the hedge, because we don't know how long the market can be irrational. We don't know how long a bubble can continue. It's very dangerous to just bet on falling US dollar prices. It's better to hedge this at the same time to bet on rising prices of the benchmark. So we only want to basically take the 80% loser statistic in our favor. So you can do this, of course, with Tesla. With Tesla, it's a bit riskier. The safer bet, of course, is to do this with companies that tended to underperform already in the past and that are likely going to underperform in the future as well. Again, just plot those relative valuation charts in TradingView. Hope you got some value out of this video. It was a bit more of a free talk kind of video, but yeah, I hope that even though this might be a bit less dense in information, it's still worth watching. Please comment down below, so it gives me some feedback around this video format. Thanks for watching again. Feel free to subscribe. Feel free to also check out the premium membership. The link to premium should pop up here on the screen. It will tell you also how I think about portfolio management. There's a lot of tutorial videos there. This is also where I share my own trades, like the Tesla stock I just mentioned, but I also have a few other trades that might be of interest for you. So thanks again. See you next time on YouTube or see you on Premium. Cheers.